Good afternoon, Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you this evening on the 30th of September. We're rounding out the third quarter, entering the fourth quarter and the back 3 months of the year. So we're happy to be here with you to give you a briefing on how we see the conditions and the economic conditions in the market as well. So let us proceed. I will share the screen and go through a couple of slides with you. And here we go. Okay, to set the table, to frame our discussion, allow me to, just talk a little bit about these broad strokes that we're seeing currently in the market. On the market side, we've got a couple of things we should talk about. The first is this conflict between rate cuts, interest rate cuts. We had the first one last month, and the idea that the economy is weak. Question mark. In other words, when we have seen monetary machinations of the reducing interest rate type, in other words, when the Fed is trying to spark or stimulate the economy via rate cuts on the short end, you often are seeing an economy that's rolling over, getting sick, not growing. And while we had a bit of concern on the labor market, it doesn't seem to be very pernicious. And to that end, we're wondering, why are we thinking about so many rate cuts when in reality, I'm not seeing very much in the way of a slow economy? In fact, it's the opposite. And you add to that the wealth effect and the consumption effect of this, bull market for the last couple of years. And I think you come out saying, well, wait a minute, what am I missing here? So that's the first thing. AI excitement, bubbly behavior, everyone's excited, but are we going to see the juice from all that spending? When is that going to materialize? Sure, we're seeing some cool whiz bang stuff. All in, love it, great. But I'm skeptical. I'm skeptical that the hype is more going forward. In other words, we're going to see the biggest implications of AI years from now rather than now. And I think the implications will be huge, but I don't necessarily think they're going to be short term. I think it takes time. I think we're ahead of ourselves a little bit there. We're seeing sentiment, as I said earlier, sharp increase of margin buying. That's leverage, folks, and low cash levels for mutual fund managers. On the economy, we're seeing the debt levels and, of course, financing of those debts with increasing deficits down the road as worrisome. We talked about the labor market. We'll have a better clue to that on Friday if we get that information on Friday. Tariffs and inflationary pressures in the fourth quarter is a concern. We'll see if that now is beginning to take hold. And then again, finally, if AI doesn't bring with it a substantial increase in revenues, then what? In other words, if this is getting too bubbly. So allow me to share a couple of quick slides with you to sort of frame those broad strokes. Here's the first one. I call it "Why Me Worry." Why, right? What me worry? Excuse me. And the kind of thinking here is that we have a chart that looks at the spread between treasuries and corporates. This is called the credit spread, right? So you guys know that treasuries are risk-free. And because of that, everything else that's priced against treasuries, that spread, in other words, you get paid more to take on risk, right? So you should have a higher return. That differential, that delta between the risk-free return of treasuries and potential, risk of other types of credit instruments, it's called a spread. And we're seeing here that there's a spread that's infinitesimal, tiny, nothing. The lowest since what? 7? Oh, I think that's an important year. You know what I'm saying? So everybody's excited. Everybody doesn't see risk. No one cares. No one worries. And this is where we're at. And this gives me some concern because I am not in the business of swinging for the fences and making the most money I can for our clients, but rather keeping them wealthy, keeping them compounding their returns over time, reducing downdrafts, making sure that their plans and their goals and their aspirations are met. That's a very different function as a wealth manager for other people's money, as a fiduciary. versus, say a hedge fund manager or a portfolio manager whose only charge is go, go, go. And I think that's a differential. This is interesting and gives us a pause. Here again, is to talk about four more rate cuts. And you see here that the market is expecting approximately 4 to 5 rate cuts from between now and the end of 26. Again, it doesn't make a lot of sense to me from the 30,000 foot view, because I don't see that need for so many rate cuts. It seems to me like the economy is just doing just fine. Now we'll see if that labor weakness of last month is a canary in the coal mine, and if so, we'll have to make adjustments to our thinking. But as of now, with this expected and wealth effect coming, and it has been here all along, consumer spending, I think that's going to sort of be a big catalyst for further GDP expansion. This is a chart that I thought was intriguing from the perspective of this notion of inflation being vanquished. You know that we are, believers of sticky, pernicious, not going to be vanquished so quickly inflation. And we've had many different conversations on these pages in the past about that, the 3 Ds, the deficit, the debt and deficit, the deglobalization and decarbonization efforts that are leading to what we'll call sticky inflation. But this chart tells you something different. It says that, hey, maybe that CPI thermometer is not super accurate. And you could see here that you're seeing a differential between the CPI in the black and this idea of what really could be true inflation, the true living cost, they call it TLC. And you could see, look at medical care, big gap, and even so transportation to some extent on the other side. But for the most part, you're seeing the green lines, the sort of real inflation maybe, or real CPI, above the stated CPI. Now let's get into the valuation discussion. Is always talk about valuation when we get together on a monthly basis, because price matters. It's not just the game or the show you're going to. It's the price of entry that matters as much as anything else, perhaps even more over the longer term. So we like to think about, wait a minute, oh, that's very exciting, that's very interesting, that's a very nice company or stock or fund or investment, but what's the costs? What's the valuation for me to participate? And here we're seeing the S&P 500 on a price to book basis, not price to earnings, price to book value. And what's telling here is where we are today at 5.4, so we've been above this 5.3 of August. And as you clearly could see here, this is a topping formation from where we were back in March of 2000. And that date should ring true to your minds, much like the aforementioned 2000s. What I'm trying to get at here is we're at substantial highs on many of these metrics. And that gives me some pause. And again, price does matter. This is a chart that looks at valuations from a different perspective. Prior, we saw price to book value, the asset values of a company, 5.5 times, to remind you. Now we're looking at, hey, a price to earnings or cyclically adjusted price to earnings ratio, the CAPE made famous by Robert Shiller of Yale University, Nobel laureate. You have dividend yield and you have EY spread, all shown here. And you can see in each case, they're substantially above their 30-year average. Folks, when things are substantially above their 30-year average, got to scratch your head. I mean, are we things that different now? Are we in such a different paradigm? Or just things are just too juiced up? And if it's the latter, it's implicit upon us as investors to peel back our enthusiasm, to sort of pull back, be patient, wait for another opportunity to put some more capital to work. And in the meantime, we could get good returns in very low to no risk instruments. So I'm not saying all or none. We don't do that. We tweak around the edges, and right now we're tweaking to the risk off side slightly. Declining. Now, this is a good slide. I showed this last month or so as well. I liked it so much. I repeated it here. What this is showing you is that the net income growth, so you're thinking about the second derivative here, not the actual growth, but not the actual net income rather, but the growth rate. And what we're seeing here is that growth rate shown in red is declining. These stocks are priced to perfection and then some. And for their growth to be declining, I think is a bit of a canary in the coal mine. Let's watch this one. Now, what analysts often do is when they're looking at their models, these are strategists that look at, the S&P 500 and other broad measures. And what they look here is they're saying, okay, well, here's what my thinking is on the earnings. And they go through their models and they're starting to say, oh, we think the S&P 500 will come in at 266 for 2025 earnings scenario. Great. So now we look at that and then we say, well, what's my multiple? What multiple will the market put on that earnings to give us the actual level of the S&P? And as you can see, we boxed it in green. There's a series of them. Back in the old days, it used to be, 15, 16, 17 used to be a normal sort of PE. We're now at 24, called here super peak confidence. And, even at that level with these earnings expectations, we're right here. So that would beg that the upside is muted going forward because of that. So we need to keep careful tabs on this unless the earnings are going to skyrocket or substantially go higher, I should say, or the multiple expands even further. And I think that that's unlikely, by the way, because it is a very rich multiple already. I find ourselves in this nowhere zone of how do we square the circle of higher S&P if the multiple is already high and the earnings are what we expect them to be. Now, again, that earnings figure can change and it can go down too. So we'll see. We got to keep careful tabs on it. This is a slide I used last month as well, froth. And what this is showing is that since April 9th, Liberation Day, if you will, the S&P 500 was up 27%, the Nasdaq's up 38%, which seems pedestrian when you compare it to unprofitable, keyword unprofitable technology sector up 57% since April. AI stocks up 60, meme stocks 77, and others that are much aggressive, even up more. Folks, stocks, sectors, etc., don't go up 50% in 6 months. I've been doing this a long time. This is getting a little bit frothy, especially when you use the word unprofitable. So something's got to give. We got to be very mindful of the risks going forward. We got to stay invested. We got to work the balance, but we've got to make sure we're protected as well. So it's a careful, important balancing act that we're doing at Align Wealth for our clients' benefit. Again, another look at frothiness. When we look at, again, profitless tech, again, companies that do not have earnings and how they've jumped so much more than profitable tech. And oh, by the way, profitable tech's not cheap either. So it just goes to show you how much more oomph there is in the red line versus the green line, again, giving us pause. Now, there's always a bull market somewhere, as I guess is often said, and to that end, we're always looking around for places where we could get a good return, a solid return for our clients, often made up of both expected upside growth as well as dividends. And to do so, we're seeing two sectors right now that look attractive. Look at the healthcare sector in red and the energy sector in black. And in both cases, you could see their weightings in the S&P 500 have come down considerably. And to that end, obviously, those sectors are out of favor. I like sectors that are profitable, and these companies often are insanely profitable, that are unloved. And that provides an entry. Remember, price matters. So that allows the keen analyst, the keen portfolio manager to pick up opportunistically at lower prices. Now, it doesn't mean it's going to work instantly. So a required helping of patience is involved here. But what you're doing is you're buying what's unloved, what's cheap. It has as it's known in the value circles, as a margin of safety. Folks, I like margins of safety. I want to protect. I want to make good returns as well. But you have to balance the risk with the reward. And you do that when you look at valuations and price. And this is what we're seeing today. So we're nibbling here, maybe a little more than a nibble. and we're seeing opportunities because they're so cheap. And value itself is abnormally cheap. And we had a run a couple of years ago in value, and you're going to see in a moment what a value run could look like. But we're buying companies that are unloved and misunderstood, and oftentimes it takes a while for that to really show itself. But when it does, it's heroic, and you're doing so with less downside risk, and that's the key. This might be a little hard for folks to see, but I love it. This is a series of years starting in 1969 to 5-year period. And what we've done here, what was shown here, is investing in the bottom fifth of the S&P's of the S&P 500 based on PE. So you look at all the 500 stocks, you look at the bottom quintile, the bottom 20% for lowest PE ratios. Let's call that a proxy for value. And then you wait the 5 years. And it's a rolling 5-year basis. So 1969 to 73, 70 to 74, you get the idea. Look at the series of returns. These are compounded annual returns. I mean, you could see here in the 70s when things were pretty tough. We're seeing in the 20s, and this is what made Mr. Buffett the Oracle of Omaha. Essentially, when everybody else was getting creamed, he was compounding in the 20s. Makes a big difference, especially when everybody else was getting creamed with technology stocks back in the day. And then here again, we've had a nice run in the early 2000s when markets were flat because of the dot-com bust. So you're seeing some good numbers here. It's only been a couple of periods when this value proxy hasn't returned big numbers. But I will point you to the last few years where we've been somewhat pedestrian in these returns. And I think this is owing to the next big value outperformance cycle. So this is where I think we're going next. And this is why we're overweighting value at that style versus growth. I hope this is helpful. We're here to help. We're here to talk with you about your portfolio, about your plans, about your financial plans, your estate plans. We're here to talk with you about your legacy. What's going to happen after you're no longer here? How will you be remembered? Maybe a philanthropic legacy is an important part of that. We're here to help. Thank you for your attention. Have a wonderful rest of the month, and we'll talk soon. Thank you.